Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate filings into something you can actually understand. Today we're diving into a recent report from Intrusion Inc., a company that probably wishes it could intrude on this video and make us say only good things, but fear not. We're here to give you the straight story. This is a special type of report called an 8K, which companies use to tell investors about big, important events that happen. In this case, it involves some financial juggling that could be a good thing or a sign of deeper issues, depending on how you look at it. The key date to remember is March 17, 2025, because that's when Intrusion made an agreement that we're about to break down. So, what exactly happened? Well, Intrusion made a deal to get rid of some debt. They did this by exchanging some of their stock for an old loan. Think of it like trading in your old car for some cash to pay off a credit card. Specifically, they exchanged just over $36,000 of a loan for about 28,000 shares of their stock. This loan was called a promissory note number 1 and was originally for over $5 million. It involved Streeterville Capital, a company that invests in other companies. Intrusion handed over those shares to Streeterville Capital in return for Streeterville forgiving some of the debt. The report says that this exchange means the loan is now completely paid off, so Intrusion no longer owes that money. Now, here's a slightly technical but important detail. Intrusion didn't have to register these shares with the Securities and Exchange Commission, or SEC, before handing them over. This is because of a special rule that allows companies to exchange securities without needing to go through all the registration paperwork. The report also mentions some exhibits or additional documents, including the actual exchange agreement. These exhibits are there if you really want to dig into the fine print. So what does all of this mean? Well, on the surface, it looks like Intrusion is cleaning up its balance sheet by getting rid of debt. That's generally a good thing. Less debt means less pressure on the company's finances. However, there's another side to the story. To get rid of that debt, Intrusion had to give away some of its stock. When a company issues more stock, it dilutes the ownership of existing shareholders. Think of it like cutting a pizza into more slices. Each slice is smaller, and that's essentially what happens to each share when more shares are issued. This means that each share of Intrusion is now worth a tiny bit less than it was before. It also signals that the company might be in a tough spot since they needed to trade equity in order to pay down debt. Ideally, a company would pay down debt with cash they generated from sales. Ultimately, Intrusion's decision to exchange stock for debt is a balancing act. They're reducing their debt burden. But they're also potentially hurting existing shareholders. It's a move that could pay off in the long run if it helps the company become more stable and profitable. But it could also be a sign of deeper problems if the company continues to struggle. So, what's our take on Intrusion after looking at this report? On one hand, the company is taking steps to manage its debt. This is a positive sign that they are trying to improve their financial health. On the other hand, issuing more stock to pay off debt isn't ideal. It suggests that the company might not be generating enough cash on its own to cover its obligations. One risk is the company's ability to generate sustainable profits. If they can't increase their sales and become consistently profitable, they might find themselves in a similar situation again, needing to issue more stock or take on more debt to stay afloat. However, Intrusion also has some opportunities. The cybersecurity market is growing rapidly, and Intrusion has the potential to capitalize on this trend if they can develop innovative products and attract more customers. In conclusion, Intrusion is a company at a crossroads. They're taking steps to address their financial challenges, but they also face significant risks. Whether they can successfully navigate these challenges and achieve long-term success remains to be seen. Thanks for watching Corporate Decoder. If you found this analysis helpful, please like this video and subscribe to our channel for more insights into the world of corporate filings. Also, let us know in the comments what company you'd like us to decode next.